Uh, Hello, everyone. My name is Simon Nguyen. Paul and I Paul's been doing this for a while, but recently we kind of joined forces and I hopped on and so that we can just combine our efforts and hopefully we can make it more entertaining. Well, thank you for having me on also, Paul. Today, our guest is Kevin Chow. Let me give you a little bit of background about Kevin. I've met him a few times and his resume is just very impressive. But here I'm going to share with you guys his bio. Kevin is a managing partner at Cornum Capital, based out of Dallas. Cornum Capital is a real estate investment firm focusing on value add, lease up, and build to rent multifamily assets in growing markets. He is a GP, which is a general partner and a limited partner on 1,000 plus units with over 200 million asset under management. He is a seasoned entrepreneur, operator, and investor with extensive experience advising high net worth individuals, building businesses, and investment management. He's also a CEO of the world's best, a curated luxury marketplace, and a former JP Morgan private banker. He graduated from Yale University with a degree in economics and mathematics. Ladies and gentlemen, please welcome Kevin Chow. All right.
Thank you.
So Kevin, I mean, the first time I spoke to you, I think it was about maybe 3-4 weeks ago when you presented this deal to me. And some of the things that, once I'm an active investor. So when I look at a deal like this, there's a few things that like really stood out to me, like from the very get-go. If you don't mind explaining some of this stuff, like one of the things that I saw first and foremost was the 100% property tax exemption. Okay, so to me, I know how it affects a person that's running the deal, the owner of the deal, but as an investor, as a passive investor, I guess people want to know, how does it affect them? I mean, how does this 100% property tax exemption affects them, and how does it benefit them?
Yeah, good question. I think as an investor, you're going to look at these multifamily syndications really like businesses. Okay. And so businesses, there's two things. You either want to get your revenues as high as possible, get your rents up, get as many people in there, or on the other side, you want to get your expenses down as much as you can. Because at the end of the day, the value of an apartment is based on the net operating income, which is the difference between revenue and expenses. So in the case of property taxes, it's a good thing a lot of people are here from Texas because you know just how much property taxes are. It's expensive, especially in Texas where we don't have income tax, and so they make up by charging a little bit higher in property taxes. Well, let's talk about how this affects this property. Well, this property tax exemption is very unique because it is part of a program that was started about 7 or 8 years ago, and about 8 to 10 properties every year gets accepted to this program, this 100% property tax exemption program. And this program is called Public Facilities Corporation. It's really an incentive for a developer to build a property for low income tenants. So what they do is, if we reserve 50% of the units for those making a certain AMI being area median income, in this case for this property, 80% of that, they will allow us to not have to pay the property taxes on that property, which in this case saves about 1.6 million a year, or $400 per unit per month. So it's a substantial savings. Now, why is that important? Well, 1.6 million in savings allows us to operate this property with lower expenses and therefore a higher profit margin. So typical multifamily operates around a 55 or 60% profit margin. Now, with our property, we're operating around 70, and our goal is to get to 75% profit margin. So much more profitable property than anything I've seen. And I've been a general partner on, I'm in 8 properties, so I've seen a lot of deals, and I haven't seen a deal that gets even close to that kind of profitability. So why is profitability good? Well, just like any business, when you have more cash flow, when you're more profitable, they're usually more valuable at the end of the day. It also gives you a lot of margin. So if there's a market downturn, a property that's cash flowing or has a higher profit margin will be able to weather the storm or withstand market downturns. I've seen a lot of properties that when the market isn't going in the right direction, they're not able to cash flow because they don't have that margin built into their business plan.
Right. Awesome. Yeah.
And
So what
that's-
I'm hearing, is margin, so higher margin and less risk.
That is correct.
Awesome. Nice. Thank you.
On a Class A property, which I mean, it's unheard of to have. Usually, Class A properties have lower profit margins, not higher profit margins.
Right. And it just to remind our audience, this property is a 506C. So what it is for accredited investor only. If you're not accredited, you're more than welcome, and we encourage you to stay on to watch this webinar so that you can learn. But you just can't invest in this one. But yeah, please do stay on and learn as much as you can. So when the opportunity of having a 506B or one day you get accredited, you can invest in future deals. All right. So something else, when I look at a deal, I mean, more important than all these other advantages is I look at first and foremost the experience of the sponsor team. Paul, if you don't mind, can you share the screen with the sponsor team?
Yeah. So this is, sorry, I have all these screens open.
Page down or something.
Yeah.
So yeah,
Here we go.
when I looked at this deal, I know one of the sponsors, Hampshire Capital with Shane Carter on it. Then I met Kevin, and then now we're familiar with Lid Living, and I just want to pass it on to Kevin and let him share with us about the sponsor team, the experience, because with an experienced team, they can weather any the storm a lot better because they've been there, done that, and they're able to pull things out of a hat, tricks out of the hat that an inexperienced person doesn't have, and that includes in this particular property the 3.25% interest rate, fixed interest rate is not, which in this economic market is just insane, right?
Unheard of. It's unheard of.
It's unheard of, right? 3.25%. So, but go ahead, Kevin, if you don't mind, go share the team, please.
Yeah. So I think when I partner up with an operator, one of the main things I do look at is the experience of the operator. I spent the last year working with a number of newer operators and in the Class B assets, and I did see some issues with people who really just weren't prepared with interest rates rising or correctly projecting what the capex will be. And I think at the end of the day, the track record of the operator is extremely key. So I'll talk about the lead sponsor of this deal, who happens to actually was the developer of this property. So Lind is based out of San Antonio. They're a very large vertically integrated real estate firm. And what vertically integrated means is that they do have many departments in the firm focused in different areas of real estate. So it's not just acquisitions. It could be development. It could be property management, investment. So vertically integrated means they have it all in-house, which oftentimes allows them to be operationally more efficient as well. I mean, most people oftentimes hire a third party, and when you hire a third party, there's going to be some level of inefficiency between the two. I think one thing that Shane, I actually met up with Shane in person just a few hours ago, but one of the things that Shane mentioned is that Lynn is such a large, again, 800-person firm. They really developed a culture within the company, a culture where people are there to work together and also strive to provide the best experience for their customers or tenants and all. One thing I really noticed is that when I look at the reviews for this property, the manager is there answering every single review, whether positive or negative, to ensure that they can provide the best experience. That's something I don't see very often, that people take the time to receive feedback and answer to their tenants. Now, going back to Lynn is a 42-year-old firm. They were founded in 1980. And since then, they focus a lot on the multifamily. That is their bread and butter. They've managed over 140,000 doors. So as you can understand, that's a ton of experience.
Wow. Oh,
Yeah.
oh man.
I mean, it makes us look like we're noobs. I mean, even 1,000 or 2,000 is nothing compared to these guys of 140,000 doors. And they've made since 2008, 4.7 billion investments broken up between acquisitions and development. As you can see on this map on the right side, they have invested in probably half the country and all. Currently, they have about 56 properties in 12 states, numbering about 20,000 units. So definitely a very, very experienced operator. And one of the things that I like about experienced operators, that they've, as Simon mentioned, they've seen things. They've gone through multiple real estate cycles. They know how to weather the storm. And one thing I always like to say is, you must be doing something right if you're around for 42 years. And you must be doing something right if you are able to invest $4.7 billion of your own money as well as investor money. So I just feel comfortable. It's run, the firm is run by Adam David Lynn, who has been with the firm 25 years. The firm was actually started by his father. The other thing I would like to mention is that we always like boots on the ground. What it means is that we like to have at least one of the sponsors, one of the principals located in the city that the property is located. And Lynn happens to be located in San Antonio. So they have, they've managed over 24,000 doors, 73 properties in San Antonio alone. Wow. So the number of properties they've managed in San Antonio is larger than most people's whole portfolio and more big companies' portfolios. So just in San Antonio alone, they've managed a lot of properties, so they understand the market, they understand the tenant.
That's right. Wow.
So I have a follow-up question on the GP structure on this, which I think would be interesting for those who are listening. What is the relationship between there's Lind, there's Hampshire, and then there's Cornham Capital? How did y'all come together, and what's the structure that you guys have together?
So it's a 3-tier structure. So maybe if we go to page, let's see, what is it?
It's a really good map.
Yeah, it's a little
that you have.
Page 37. Kind of gives an idea. So this is certainly not a typical syndication.
Right.
Page 37. The typical syndications, you just have the let's say the top entity that holds the apartment, and then there's just 2 share classes. So class A, class B, GP and LP. Usually it's like that. In this case, because there's a number of big parties involved, there's essentially 2 JVs, okay, and then a SPV, a special purpose vehicle that we've created to bring our investors. So we'll just kind of start from the top.
Okay.
So Caliber Commons LLC holds the apartment, and then there's a joint venture between JP Morgan and an entity that was formed called Caliber Commons 2023 GP. Now, it doesn't mean that everything inside that is a GP, but we'll just call it Caliber Commons 2023 GP. Okay, so JP Morgan is coming in, and I want to stress they're coming in as LP equity. Okay, one thing that's not very common is that institutions are oftentimes come in as a preferred equity. What that means, they sit a little bit on top of the rest of the equity stack. They'll get the first cash flows. The difference is JP Morgan is actually coming in as LP equity, and all the people who are going to be investing in this deal, investors are coming in, will be entirely pari passu with them. What that means is they are side by side. They get the exact same returns as JP Morgan, which is phenomenal because it is not very typical for a large institution to kind of say we're going to share the rest of the stack with someone, we're going to share our returns with someone. It's typical for them to say, hey, we're going to get a higher return than you because we're bringing in large money. But the great thing is you get to sit side by side, even though from the map standpoint, you're a little bit lower and all. But I want to stress that the returns are identical between JP Morgan and the rest of the investors. Now, as we move down the first JV is between the GP structure and JP Morgan. And then within the GP structure, we created a joint venture. One joint venture is between Lind, and then the other venture is between Hampshire Capital and myself. So we joined together and created a special purpose vehicle, another entity that are with the task of bringing in the investors into that vehicle with us. They're coming as LP Class A, okay? And then the general partners, that would be obviously Hampshire, myself, and then other general partners like Simon and Paul will receive Class B shares in this Hampshire Capital. So all of us will be in this SPV that we've created to invest into. So
this Hampshire San Antonio #1 LLC is the SPV that has the JV with Lind.
That is correct.
Okay, gotcha.
Awesome. Yeah. So just by looking at this chart, and I see JP Morgan interested in investing and putting up 34 million out of the 40 million that's for equity, tells me that they're very comfortable in this deal because they have a whole team that does the research and have already looked through the market and they're very comfortable. So which tells me that if they're comfortable with it and we're pari passu with JP Morgan, it'll be a pretty good investment, right?
Absolutely. It is not very common that we see like an institution again come in as a LP equity. They usually come as preferred equity, and they usually come in with quite onerous terms. Okay, in this case, JP Morgan's terms were very, very normal. It was nothing aggressive at all. In fact, one thing I want to share today with you guys is that just a few hours ago, we finalized our agreements with JP Morgan, and one of the big news that came out of it is that JP Morgan is not taking depreciation. And as a result, all the depreciation will flow down to the LP and GP investors. So initially, we had projected about 100% first year depreciation. That projection has been revised to at least 200%. It could be substantially more. Okay. And how?
Go ahead.
Yeah. And so question that people ask is, how do you get 200% depreciation? What does 200% depreciation actually means? Right. That's probably the question. So what is depreciation? Well, depreciation is a way to essentially offset income distributions, passive income, capital appreciation. So it's a way to to lower your taxable income so that you pay less. So having more depreciation is valuable. Okay. So how depreciation is usually determined is that something called a cost segmentation is done on a property where they try to determine how many dollars of depreciation can be allocated from that property to its investors. Okay. Now, new properties tend to have more depreciation. They might get, let's say, as an example, 50%. So let's say this property is being acquired for 76 million. 50% of 76 million is 38 million. Okay, older properties tend to have less in a proportion to its price. So to get the most appreciation, you want to get a really new property. In this case, this is a 2021, pretty much a brand new property. So you got a lot more things to depreciate. So let's say you have 38 million depreciation. Okay, then you take that 38 million and determine where that 38 million is going to go. Well, since JP Morgan is foregoing it, well, we've got left with 6 million in equity. So we got 38 million to distribute to 6 million. Well, that divides up. That's a lot of depreciation per dollar. Now, granted, this year there's an 80% bonus depreciation. That means we need to take that 38 million as an example. Let's just do 40 million and multiply by 0.8. So that means we can't if we were investing this property last year, we will get the full 40 million. This year, because bonus depreciation only 80%, you get 80% of that number, which let's say is 32 million. Well, still 32 million going into 6, that's like 5 times. Okay. So technically, if we decide to give everything for LP equity, we could be giving somewhere like $5 of depreciation for every $1 of investment. Okay. Now we are going to allocate some to the GP, so it's going to be less than that. And we will know probably within the next couple of days. We're in discussion with Lynn how much we want to allocate to both sides. But as I mentioned, probably it's $200. That means if someone puts in $100, they will get a K1, which essentially has a net loss depreciation of $200,000. So,
so that's I'm going to piggyback on what you shared so far. So if they have $200,000 worth of depreciation to offset, and if they don't use all of it, they can carry that on to the next year, right?
that is correct. That is
All right.
correct. So if you don't use it on 1 year, have no fear. You can always roll over to next year. It doesn't disappear and all. And the great thing is it will be used to offset like all of the distributions probably going forward all the way until you sell the property. So if you get a 6% distribution next year, $6,000 on 100,000, that's tax free. And then the next year you get $13,000 tax free and all. Very different than if you had a stock and you got dividends from a stock. If you got dividends from a stock, guess what? It's a taxable event. You got to pay taxes and all. You can't offset it. But if you got distributions from this investment, it comes in tax free.
Yeah. And that's what I like when I looked at this property. Those are some of the things that caught my eye right away. The other thing that I saw that caught my eye was that it's built in 2021, so it's practically new. There's not a lot of capital expenditures that are needed, right? You got the roof. The roof is only 2 years old. The air conditioner is 2 years old. So there's really not much that you're needing to fix. So there's not a lot of expenses that you're having to allocate towards those expenses. So that to me that's bodes well for investors. If you don't mind sharing some more information on that, Kevin.
I think you brought up a big point, which is right now, especially given the market, one of the things I'm trying to do is find investments where we have the least amount of risk. Okay, 3 big risks we're trying to mitigate with this opportunity is one, with the fixed rate, we have no interest rate risk. So if interest rates went to 12%, we are totally safe. In fact, if interest rate went to 12%, that's great for us because rents will probably go up. Less people will be buying homes and they will probably be renting out of a Class A asset. So interest rate risk is off the table. Another risk is, as Simon mentioned, CapEx risk. I've seen a lot of deals where the CapEx were under projected. Materials went up, costs went up, labor costs went up because of inflation. And so what we thought we had budgeted in our CapEx budget was now 20% more. And so without that CapEx, we have no CapEx risk. And finally, another thing is the property tax risk. So without paying property taxes, even if our property appreciates in value, we don't have to pay extra property taxes. So that's off the table as well. So again, looking for opportunities to de-risk the investment, and got some good numbers right there. And then I think that we have to update that projected first year 100. It should be 200.
It's
But one
200
number,
now.
yeah, 200 now, just a few hours ago. But one number that I think is very important to emphasize is the break-even occupancy. So what break-even occupancy is what occupancy is required for the apartment to essentially be able to keep the lights on, pay their expenses, and also pay their debt. Okay. Now, a good break-even occupancy is anywhere below, they say anywhere below about 75, 80%. I've seen some at 90%, but I don't invest in those. But I would say anything below 75, 70, 75% is usually very good. In this case, it's 65. That means we can have 1/3 of the apartment empty and still be able to stay profitable, which is very strong when, especially given that there are properties right now that are just bleeding money.
Right. Yeah, when you have less expenses in property taxes and you have a low interest rate and you have low maintenance, it solves a lot of problems. Definitely.
We
We
have
do
a
have a question.
couple
We
of
have a question in,
questions. Yeah, before we jump into those questions, I want to really quickly set the stage for when the investment is, like, when you're closing on the property, when does the project close down for investors? And if I recall, well, I guess I don't want to guess, what's the minimum on this one, Kevin?
Yeah, so again, this is for accredited investors, and maybe I'll kind of jump in and describe what an accredited investor. I think a lot of people may not be familiar. So accredited investor, there are a couple of ways to be verified as an accredited investor. One is having a net worth over $1 million, and with not including primary residence.
Right.
Number two is an income of 200,000 as a single, or 300,000 married within the last 2 years, and with the expectation that you will have a similar income this year. The third way is typically for financial, I guess, advisors, people with Series 7, Series 65. Anyone that's licensed usually will count as an accredited investor as well. And then if you have an LLC, as long as the members within the LLC are accredited by the definition that provided before, they will be considered accredited investor. The way we get verified is there's a accredited investor verification form that Simon or Paul can send to you. Usually a CPA, investment advisor, or lawyer will be able to sign off, as long as they understand your financial situation and can attest to your net worth or income or license. So that's how someone's verified as an accredited investor. Now, the investment minimum is 100,000. However, if someone is interested in investing lower, we can discuss on a case-by-case basis. If someone decides to invest a large amount over, let's say, 250K, there may be what we call GP shares allowed, just a small little GP share that we will also provide as an incentive for those who are looking to make a larger investment.
awesome. Thank you for sharing.
What's the time frame on?
Oh yeah, the time frame. The time frame is we would like to have all funds in before the end of the month. Okay, we would like to get the docs, or at least get a reservation of docs signed through the portal within the next week or two. I know tomorrow will be making some of these announcements of some of the depreciation, as well as the preferred returns. These are new updates that will probably be bringing a number of investors. Speaking of the investment structure, I think maybe I'll just segue really quickly and talk about the investment structure since we're on the page. So we definitely have a very, for those who have invested in this syndication, invest in syndications, you probably have an idea of how the structure looks. Some syndications do not have preferred returns. They're just a straight up split. I will say I almost never invested any investment that doesn't have a preferred return. Why? Because preferred returns provide a downside protection. And how preferred returns work is, let's say you have a deal with a 10% preferred return like this one. What that means is, if we were to sell this property and give our investors back the money 5 years from now, we need to give our investors 10% times the whole time, 5 years, which is 50%. We need to give you 50% of your money back before the general partners like myself receive even a dime from the remaining cash flow. And that gives a sort of downside protection, because it essentially says that, hey, we need to work hard to ensure that the property exceeds expectation and gives you a return that well exceeds that 10%. Okay. I will say
just to clarify that, Kevin, that's after returning their capital, 100% of their capital, then 50% on top of that, right? Before the GP would ever see any income from that, right?
That is correct. Okay. That is preferred return plus capital contribution, return of capital. That is correct.
All right.
Yes.
Appreciate that.
And just to give you an idea, the typical syndication, I would say 90% syndication I've seen with preferred returns are 7 or 8%. So a 10 is definitely on the higher end. And you investors must thank JP Morgan for negotiating terms. They are a little bit more aggressive than typical investors, and therefore you will see that some of these terms are a little bit more favorable for investors. Once we reach that 10% preferred, then a split begins, and that's very typical. A split means a portion of the remaining cash flows gets split to the LPs, the investors, and to the GPs like us. In this case, the split is about 82.35 for the LPs and 17.65 for the GPs. It's a very strange number, and the reason is because of the multiple structure layers, we had to calculate a number that fits for a single layer that most people are used to. So as an apples to apples comparison, the typical split is a 70-30 split. Okay, so it's usually an 8 pref with a 70-30 split. In our case, it's a 10 pref with an 82 and a 82.35, 17.65 split. So that means overall, there's just much more cash flow going to investors than the typical syndication. Okay, so what does that mean? Well, it just means that you guys, again, have more downside protection because you get more cash flows coming back to you when the property gets sold, as well as during the ownership of the property.
And then in addition to that, there's only an 8.85% acquisition fee, which is quite a bit lower than I've seen before.
That is correct. So the typical, I've seen 2.5% off the purchase price. In our case, again, thank JP Morgan. They decided they don't feel that giving 2% was too much for them, and so they negotiated a 0.85 acquisition fee, which also means that we as the GPs are aligned with our investors. We've seen a lot of syndication deals where there's a lot of fat fees thrown in there. They're going to charge you the acquisition fee. We're going to charge a refinance. We're going to charge you disposition. We're going to charge you, I don't know, other imaginary fees. And then before long, people are saying, well, how does the operator have an incentive to perform if they've already made all their money on the front end? Right. Well, in our case, the only thing we're making on the front end is this 0.85 acquisition fee. And during the hold, there's going to be a very minimal asset management fee, which is 1%. Again, lower than most asset management fees, which I don't know, it's like 1.5%, 2%.
Yeah, I see 1.5 a lot.
Yeah. So our asset management fee is probably break even for us. And until we sell the property, we really don't make anything until we sell the property. But again, that puts us on the same side as our investors.
Perfect.
Great point.
Great answer.
Great point.
And so for the time we have left here, we can start wrapping up in the next 5-10 minutes. We have a couple of really good questions from John. Todd just asked, it's a forecasted 6-year hold time, Todd. John had some more in-depth questions about the the tax structure. Can you see the questions, Kevin, in the chat?
Yes. So the first question is, can you expand on the number of properties where we granted a PFC status per state or per metro? So the PFC is a Texas exclusive program, the PFC Public Facilities Corporation. It was created, I think, about 2015. And as I mentioned, only about 8 to 10 properties. So I think the whole state right now, there may be 40 properties. It is limited to Class A. So you're not going to get this on a Class B property. It has to be a property that's built within the last couple of years. Additionally, there have been studies showing that this is so beneficial for developers. They're looking to get rid of it. However, properties that are already on it, it's grandfathered in. This is a 75 to 99 year, I guess, program, I guess what we call it. Wow. So we essentially would get this for the lifetime of the property as long as we keep 50% of the units for those making 80% AMI, which I forgot to mention. We found a loophole for that because this property is in a high area median income area, about 83,500 for a family of 4. We can rent out all of our units at full market price and therefore have no loss to lease. The idea of the program, we were supposed to rent below market and then therefore get that tax incentive. Paul is throwing some great pictures of the location. As you can see, Paul, you want to scroll back up a little bit?
Sorry, it's the delay is killing me.
No problem.
Here we go.
Yeah, so I always like to say you can judge the area by the stores you see around it. So if you see Targets, you see Home Depots, Ford, Core, you see high school, Starbucks, that's a Class A area. It's right near retail Class A area.
And this right here is the property.
There you go. Yes. So another thing to emphasize is that this is not Section 8. So the tenants must be approved based on the merit of their income. So I think it's 2.5 times rent. So a pretty typical standard. So they must be able to be approved for the unit and all. And there is no rule on how we can divide up those 50% of units. So conceivably, we can put more of our lower income, those that are reserved, into the smaller units, okay, and then the market at the higher units if we wish to do that. But again, they're not Section 8. There's no vouchers. The tenant base is primarily younger professionals, new in their career. It's not what people will consider the typical affordable housing tenant. Long-term implication on rent limitation, even the property sold to another owner. So the PFC structure can be passed on to the new owner. That's very, very key. So they too will get the benefit of it. And so they too, when they buy the property from us, will pay that value of that PFC, which is obviously a very, very valuable thing. I mean, just to give you an idea, that PFC is probably worth over $30 million. Okay, so if you look at like a 5% cap rate, you would take that 1.6 million multiplied by 20. That's about a $32 million value on that PFC structure. But let's just round it down a little bit. Still about $25 to $30 million. Very, very valuable. Another reason why they're thinking after 7 years, they're like, we're not seeing any changes to affordable housing, low income. We may have to get rid of it. So this might be one of the few chances to be able to invest in a property like this. Once the PFC is granted, who will own the property? So just to give you, just to be transparent, what is happening here is not a true acquisition. So Lynn developed this property. We're doing something called a recapitalization. So it's a pseudo acquisition. What a recapitalization is, so when Lynn built the property, they had some investors alongside them. Now those investors have completed a project, which is build the property, and they are looking to switch out, I guess, leave, and we are replacing them with new investors, which would be JP Morgan and you. So that's what a recapitalization is. It's just a changing of the equity stack, bring in, and it's very, very common. because everyone has a different investment thesis. Investors that invest during development, they don't typically stay on to invest during the operations or lease up phase of the property. So it is very natural for them to get out because that's not their specialty. Their specialty was to build the property up.
Awesome. I think there's another question on the Q&A. Jin Hone asked, can you please explain the bonus depreciation now that Chase isn't taking them? I think you answered that question earlier, but
Yeah.
if you don't mind, just quickly, briefly.
Yeah. So again, we estimate, again, until we do a cost seg, we can't know for certain, but let's say there's $40 million, usually about 50% of the new property, maybe a little bit more. So if there's $40 million of depreciation, that $40 million has to be allocated to the investors. Okay. It could also be allocated to GP. Now, if JP Morgan was in, okay, that 40 million will be given to everyone. So there's 34 million JP Morgan, 6 million for the rest of the investors, 40 million there, 40 million in depreciation. So you get dollar per dollar. So 40 million goes to 40 million of equity. Everyone gets $1. Now with JP Morgan 34 million out of the picture, we have 6 million now, but we have that same 40 million of depreciation that we need to give to that 6 million. Now, every person in that 6 million get a little bit more. So you take 40 million divided by 6 and you get what, 6 point something. So now conceivably everyone could get $6 of depreciation for every dollar they invest at all. Now I did mention about that bonus depreciation. What bonus depreciation means is what portion of that 40 million we can actually allocate in the first year. And in this case, 80% of that 40 million. So if 40 million was the initial depreciation number, then 40 times 8 means 32 million can now be allocated to the 6 million in equity.
Wow, that's that's
Pretty
a lot of
compelling.
money to offset.
Oh, I know,
for a
I
long
know.
time.
It's not very common. I've done some deals with 110. The highest I've seen up to now is 110. That was again a class A, but the only way that you can leverage it so high is this way. New properties, a really brand new property, and a big institutional investor who decides
who doesn't
they don't
need the
take it.
depreciation. Yeah.
It's a unicorn to get that much depreciation.
So I have a
Yeah.
question about that. So say if somebody invests with their, say, self-directed IRA and it's a Roth and they don't need the tax breaks.
Okay.
How similar to what JP Morgan's doing, can they just elect out of the depreciation and let somebody else have it?
Yes. So that's what will happen. So if someone has an SDIRA, unfortunately, they can't take the depreciation. It does get reallocated to the pool and divided up among the rest of investors.
And how do they indicate that to you in the portal? And in fact, Simon, it might be a good time to send them the link to the portal for the investors portal.
Right.
How do they tell you?
So when they sign up, there are multiple different entities they can choose. They can invest as an individual, as an LLC, as a trust, as a joint registration, or as a retirement account, an IRA. So if we see you guys invest as an IRA, we will know that you probably would not be able to take the depreciation. Okay. So, and for anyone that's looking to invest through an SDIRA, on who hasn't or is curious of how it works, it does take a while. So if you're looking to invest through an SDIRA and doesn't have an account set up yet, it would be good to get it set up because it usually takes 1 or 2 weeks just to get it set up, and then another 1 or 2 weeks just to get it funded. It's a lot slower to invest through an SDIRA than straight up cash. Cash, you can just go and wire next day, but SDIRAs takes a couple
you
of
have
weeks.
you have to, like a lot of people in Texas probably use Quest, our Quest Trust Company, and
Yep.
It takes a little bit. If you haven't funded it before, it takes a while.
Yes.
Yep. Yeah. All right. Any other questions, guys? That's awesome. Very informative. A lot of good information. And Paul and I always joke with each other, and we say that hey, we don't ever claim to be gurus or expert, but that's why we have guests like Kevin Chow to
But
come
Kevin
in
is, yeah.
Kevin, can we bring Kevin in and he makes us look good? Well, honestly,
We're all a
what-
team here.
yeah, what we're trying to do is, hey, we're trying to learn just like everybody else, and we bring in experts so that that we can learn from them, and at the same time we can share our learning experience with our guests. So that's the whole purpose of us doing this, so that we can hit many birds with one stone, right? So
Absolutely.
all right, well, that wraps it up. Thank you, Kevin, for coming on board and sharing your knowledge with us and sharing this awesome opportunity. Folks, if you guys are interested in investing, just please sign up to the portal. If you need to ask more questions, I can send you my my Calendly link, and please do book an appointment with either Paul and I, and we can we can get on a one-on-one call with you, so we can answer any questions you may have. All right.
Perfect.
Well, thank you very much.
A quick close-off section. If anybody asks us for this recording or for the slide decks, do they need to sign an NDA, Kevin?
No,
Okay.
no, not really.
Okay. So we're free to share this with anybody who asks.
Sure. Mhm.
Okay. Good. So if you guys want to see if you want a copy of the slides, since we didn't go through every single one of them, it was quite a long presentation. We'll send those to you and let us know if you have questions.
All right. Well, thank you for coming on board, Kevin, and good night, guys. Thanks for
Thank you,
joining
everyone.
us.
Thank you, Simon
All
Paul.
right.
Take
All
care,
right,
guys.
bye-bye.
See ya.